Hello, my name is Clive Corcoran and welcome to my YouTube channel, the Corcoran Codex. What I'm going to cover in this video relates to the world of foreign exchange options, and I shall look at the way that they are priced. I shall talk about their behavior, the reasons and motivations for using them, and I will also pay particular attention to an explanation of straddles, why they can be useful in the world of FX options. FX options can be either exchange traded in a similar manner, say, to options on equities, or perhaps, especially in the case of FX options, they are often OTC products where a customer would approach his or her bank and get the bank to grant a particular custom option for whatever purposes they need it. Having a long call position in, say, a Euro US dollar option gives the holder, the buyer, the right but not the obligation to buy euros in exchange for a specific amount of US dollars, and that is determined by the strike rate or strike exchange rate within the option contract. A long put position in a Euro US dollar option gives the holder the right but not the obligation to sell euros in exchange for an amount of US dollars, again in accordance with the strike rate. So let us take as an example a particular option here, which is for sterling or the pound against the US dollar. And I captured this data for the pricing purposes on March 27th, 2026. At the particular time on that day when I captured the pricing and so on, here were the applicable rates. And what I did was to put these into an Excel model, which essentially is an adaptation or modification of the Black-Scholes option pricing model, but that model needs to be adapted for FX because we can actually include reference to two currencies and the appropriate interest rates and so on. Anyway, at the time when I did this, the spot rate in the market for sterling against dollar was 1.3285, as you can see. And based on what I'm going to come to over here in a moment, what I did was find a strike which is more or less the same, within 1 pip actually, because I want to talk about an at-the-money option and also essentially what is known as a 50 delta option. Now, with regard to the modification to Black-Scholes, this is what allows us to enter two relevant interest rates for each of the currencies. So in this case, we have the base currency, which in this case is the pound, and the 3-month SONIA rate, which is the sterling overnight index average, at this time is quoted at 3.75%. Now, the similar relevant rate for the quote currency, which in this case obviously is the dollar, we are going to use, or for this rate, we're going to use 3-month SOFR. That is ultimately based on the overnight repo rate, but this is a term version of that, so it's 3-month SOFR. And that was at the time quoted at that rate, 3.72%. So these are very, very similar. Now, this is a 91-day option, essentially a 3-month option to coincide with the discussion we'll have shortly over here. That's the fraction of a year for 91 days. Now, the implied volatility input we need for the model, I'm going to also take this amount over here of 8.41%, which is the amount that was being used in the quotation for this particular option on this day and for the 3-month option. We can see here that based on those inputs to the model, we can see that the call for the 3-month option is priced at 221 pips and the put very similar at 219 pips. We can also see that one of the outputs from the model is the delta on the call just slightly above 0.5, which is very often what might be seen for an at-the-money option, and the delta on the put is very close to negative 0.5, as can be seen here. So what I wanted to do next was to, if you like, check the use of the model and the inputs to the model against the actual pricing in the market at the time when I was pricing this. So we can see here, this is from Sentry Derivatives, which is one source of pricing in the options market. This is the sterling dollar spot rate, which I have used over here. There are a series of maturities expressed here, overnight, 2 weeks, etc. And I've used the 3 months to coincide with the 91 days here. We can see this up here. So this option expires within 91 days of the March 27th date. And we can also see now the at the money strike, which is the one I've used, 1.3284, which is again here. And this is the 50 delta, which is more or less in agreement with this number here, we can see. And the price that's being quoted for this is 219, or actually close to 220 pips, which is extremely close to the value which is the output from the model that's being used. Just by way of interest, we can see that at that same strike, the price for the put is at 220, which again is very, very similar to here. And the delta is also at negative 0.49, which is very, very much in line with, again, the output from the model. Before I move on, what I want to discuss is down here. Now, this curve, as you can see here, this is based on the current implied volatility, this column over here. And we can see that for the current, which is obviously the one that's being quoted here, we can see that we have this shape which looks somewhat like a smile, or at least part of it does down here. And this is one of the features of options generally, and in many ways it is particularly characteristic of FX options. We can see that the implied volatility is not a constant. One of the assumptions behind the Black-Scholes model is that there is a uniform implied volatility across all strikes. But that is not in accordance with market behavior, where practitioners are prepared to pay more, for example, for, in some cases, deep out of the money or even deep in the money options. And this is especially true, perhaps, in the world of foreign exchange. Let's move on now to another example. In this case, I'm going to use a Euro-US dollar call option. It's a European style option, which means that it can only be exercised on the final day. So let's consider now a long position in a 1-year Euro-US dollar call, which would enable the holder to be able to obtain 1 million euros with a strike set at $1.15. So another way of thinking about that is that it would enable the holder to pay $1.15 million to buy 1 million euros at expiration. Now, if the exchange rate at expiration is below the strike, the $1.15, the holder simply will not exercise. It would be cheaper for the holder or the buyer of the option to go into the spot market and buy at the spot rate, because you haven't yet achieved the strike rate of $1.15. The seller of that option would thereby benefit by essentially retaining the premium. Now, if the exchange rate, let's say at maturity, is now $1.20, the holder will exercise because the euro has moved above the strike rate of $1.15. And we can see in a moment that the gain to the buyer would be $50,000 less whatever was paid for the premium on the option. And the seller of the option, in this case, actually loses in line with the gain to the buyer of the option. So the seller of the option, if not hedged, would actually have to go into the market to pay $1.2 million to obtain the necessary 1 million euros, and then turn around and provide them to the buyer for 1.15 million. So there's the $50,000 loss. Let us now turn to the mechanics of the option and look at what is sometimes called the payoff diagram. So here we can see here a series of exchange rates at maturity for this option, starting over here at $1.10, where the exchange rate at maturity is $1.10, over here to $1.20. So the strike has been set at $1.15 as before. We're going to set the price of this, or premium for this option, at 200 pips. And let us now consider what the actual payoff diagram would look like. Well, let's say we are here. This is the $1.15. This is the strike. So that corresponds to this positioning here. On the horizontal axis, we have the exchange rate at maturity. And on the vertical axis, we have essentially the P&L for this option. So the first thing to notice, of course, is that there is the requirement to pay the 200 pips for the option. So that represents, if you like, the cost and effectively a loss, if you want to think about it like that, to the buyer, that there is a 200 pip outlay. Now, what happens here is, let's say the exchange rate is down here, say at $1.10, then the option has no intrinsic value and will not be exercised, but the loss to the buyer is confined to the 200 pip premium. Now, as we move to the right, in other words, as the exchange rate moves above the strike, the $1.15, we can see that this line here, the net payoff, starts to work in favor for the buyer. Let's say the exchange rate at maturity is $1.20. Now, this is 500 pips above the strike. That would be the gain, but we need to offset that with the premium, the cost of the premium, which is 200. So the net P&L is 300 pips. And in fact, once we move beyond the strike, we start to recover the 200 pips at $1.17 here. We break even, and from there on, as the exchange rate keeps going higher, so the gains to the buyer could continue to mount. What I want to consider next relates to what are known as strategies in the option world, and this is where we start to combine a number of option positions. The one I'm going to look at to begin is known as a long straddle. Now, let me just briefly discuss what the motivation for this would be. Let us suppose now that the buyer has the opinion that there's going to be a fairly sizable move in the euro-US dollar exchange rate. Maybe there are some issues around central bank monetary policy which might make a significant move more likely. But maybe the buyer is not convinced as to which direction the move will be. He or she believes that there will be a sizable move, but is uncertain about which direction the move would be. So what they decide to do is to go long a straddle. And how does this work? Well, the idea here is that you buy a call and a put for the same expiration date. And let's say this is going to be an at-the-money strike we're going to work with. So let's say we work with $1.15 as the strike on the call, and likewise on the put. Let us suppose that the price for these two options is equal at 200 pips. All right, now let's consider what the possible outcomes might be. Well, the first thing to notice, of course, is that there is the 400 pip commitment by the buyer when entering this long straddle position. The worst outcome for the buyer is that there is no movement either way at all. So the exchange rate at maturity is also $1.15. So there is no gain on the call, no gain on the put, and in fact the buyer would then be down 400 pips. Now the idea then is to say, well, when would this become beneficial to the buyer? Well, the idea is we would need to add these two, so 400 pips, bringing this to, let's say, 1.19, which we can see here. So if the exchange rate moves above $1.19, then the call starts to make money, and the buyer has broken even and can then enjoy any further move over here to the right. On the other hand, let us suppose that the exchange rate moves down, and we need therefore to deduct the 400 pips from here. So this brings us down to $1.11, and at that point any move further to the left, in this case further that way, would then represent a gain to the buyer because the put starts to kick in. The call would be written off as worthless, but the put starts to kick in, producing a gain to the buyer. So we've talked about a long straddle. As I said, the motivation is to expect a large increase in market volatility where the exchange rate moves around considerably. We've already talked about how this can be achieved by buying a call and put with the same expiry and the same strike prices. The risk to the buyer is limited to the premiums paid. The maximum reward is actually unlimited because, let's say the call kicks in, well, theoretically that could produce unlimited gains. The final slide I'm going to come to is a short straddle, and perhaps as can be seen, the motivation for this would be the seller, let's say, believes that there's not going to be a lot of volatility, so is prepared to sell a straddle to the buyer on the belief that there will not be a significant movement in the exchange rate. So let us actually look now at the short straddle, the payoff diagram, and we can see basically now this is the position of the seller of this option. You sell an at the money call, let's say at $1.15, and for the same expiration date you sell a put also at the money with the same strike. Let us suppose once again that both these options have a cost of 200 pips. So once again the combined position would therefore be 400 pips. And what we can see now is essentially the upside down or inverted image of what we saw just a moment ago. For the seller of this option, there is no payout to the buyer unless the exchange rate moves below $1.11 or above $1.19. So in this area here, the seller would then retain the premium, the 400 pips. And in terms of losses now, because losses for the seller are not capped at the premium, because let us suppose the exchange rate does move this way, then the put starts to have value, and this would then be of benefit to the buyer, but it would also be a loss that's now being incurred by the seller. And likewise, if we move to the other side, if the exchange rate moves higher than $1.19 and keeps going this way, as can be seen, then we could actually see that the seller, in this case over here, would be down 600 pips. Well, thank you very much for watching that video. I hope you found it useful, and I would like to encourage you to subscribe to my channel, the Corcoran Codex. There is no obligation, you're not required to pay any money to me, but you will then be notified as to when I release new videos, which I do fairly frequently, and all of those videos are centered around the subject on the screen, which is analyzing critical ideas and episodes in the world of global finance.